John was run over by a bus. He makes a lot of money. He's got life insurance. He's got all the stuff that he's talking about. Are you happy, or do you want to sue the person for running over your husband?
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
This is John Smallwood back on Money Isn't. We're going to dive into the concept of whole life insurance compared to the term insurance. This is a topic that I've been doing this for 35 years, which I feel like I'm about 25, so I don't know how the hell that happens, but I've been doing this for 35 years. And this argument is a ridiculous argument because the industry has trained people to think that we don't need life insurance when we're closest to mortality. Okay? Meaning I might die young, but the probability is I die later, right? Hopefully. And when we think about it, the need, the want, and the value of life insurance in many different people's estates, whether they have estates that are taxable above the estate tax limits, but specifically for people that are under the estate tax limits, the value of life insurance in a long-term plan, life insurance to age 100, to age 120, which is where policies go today, and I'm sure they'll be longer in the future. But the reality is, how does it work in each phase of your life? And the argument that I can do better with my money in other places assumes certain assumptions, which I like to say that in double way there, assuming assumptions, right? Because we know they're both stupid, right? And the assumptions are always wrong. And because you can't predict the outcome of how things are going to play out into the future, right? You can only look at things and say, let me make decisions based upon factual decisions, but those facts are going to be subject to change, right? Because you have in your assumptions, you have the rate of return that you can earn, you have the time that you're going to compound it, you have an assumption of taxes, you have an assumption of your health, you have an assumption of your expenses, you have an assumption of inflation, and all of those are subject to change. And when you change one variable, you're going to get a different outcome. You change 2, 3, 4 variables, the plan's not even the same freaking plan, okay? What I want to do today is we're in a closed environment and we're talking about a siloed time frame with assumptions that we're going to vary as we have the conversation. But what I want you to understand is that the decision of life insurance, how you own it versus how you rent it, is going to make a huge difference in your retirement if you've structured it properly. If you're overfunded or underfunded in any particular category, things won't necessarily work the way we want them to. Okay. So what I want to do is I want to just go back to the concept that we were talking about. We're talking about an individual, and we're not talking about the proper amount of life insurance. We're not talking about any of that. We're just talking about the concept of how it works in a plan and how it might work in your plan, right? And the question that I always ask myself and my clients is, do you want to have a strategy that pays less taxes? Do you want to have a strategy that has less risk? Do you want to have a strategy that has less fees and costs? Do you want to save more money, maximize your current lifestyle, have more benefits and more protection, have more retirement income, and pass more to your family or your loved ones or your favorite charities? And it's like a stupid ass question. And people actually think in their brain that To achieve those goals, I have to give something up. Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. And that's not true. Most financial strategies are doing the exact opposite. And we're going to talk about that today. They're increasing taxes, they're increasing fees and costs, they're increasing risk, they're decreasing their savings, they're decreasing their benefits, they're decreasing their retirement income, and they're passing less to their families. Why are we following that trap? So what we had here is on the screen. If you're listening in the car, you can watch this in YouTube, you can see it on Spotify. There's multiple video screens that we're sharing the concept so you can see this. What I want to do is we have a scenario where we have a 35-year-old and we're going to age 72, 73. We're not looking at the time horizon all the way out to 100. In a different strategy, we're going to do that. Every financial plan that you should build should have it set up that you're assuming that you live beyond age 100. Some people won't. Some people will get real close and some people will go beyond, right? Your plan needs to be prepared for all of those outcomes, okay? But we're looking at this from 35 to 71, and we're going to pick an arbitrary age out here of 67. I forget what we used in the last conversation that we did this, but what we were saying is this person has $400,000 of non-IRA assets. We'll have a different conversation where we talk about IRA versus all this other stuff. They're earning $250,000 and they're spending 75% of what's left over on an after-tax basis. So when you look at that, you're looking at this and saying, when you see this screen, I'm going to blow this up, the income, $250,000, and taxes are about $59,000, which has a lifestyle of about $151,000 is what we're going to be focused on this. And we're freezing. I have the lifestyle increasing by 3%. And I have the salary increasing by 3%. I have no clue what inflation is going to be. I have no clue how your income is going to increase, nor do you, okay? But what I want to do here is what we did is we said, and this is what I want you to focus on for a second here is, if this is the case, we don't have any pressures, there's no college, there's no hey, let's improve the house. There's no failure to launch in here, weddings. We're not putting any of those things into your plan that are going to be here, okay? Depending upon your family makeup. But if I pick 68 years old as the initial time frame here, that if this person is able to grow their wealth over that time frame without taxation, we're at about $41 million, $41,942,000. And I want to make a distinction here that we broke down the portfolio. We said we're going to allocate 100% of this to the S&P 500, which nobody ever does, and you shouldn't, okay? But for concept, I want to go against something that has a really interesting long-term rate of return. And we're going to break the tax distribution down into three elements. So when you take your portfolio, there is short-term dividends, there is interest, there's qualified dividends, there's realized capital gains, long and short, and there's unrealized gains. I bought and held this stock. So what we're saying is, for concept, 33% of the return is going to be taxed at a long-term capital gain. 33% is going to be taxed at a short-term capital gain, which is ordinary income. And the 34% of the portfolio is going to be unrealized, meaning we're buying and holding, okay? So when you look at this on the curve, if the $400,000 portfolio, using the average rate of return on the S&P from 1988 through 2023 year end, was 12.42. So if that was broken down into a 12.42% rate of return, 16,000 is short-term gains. Long-term gains are 16,394, and the unrealized portion of the portfolio is 16,891. Okay. And that compounding is, I want you to understand this distinction because this is important. But what happens is when I tax the gains on the portfolio, what you're seeing in the first year is the portfolio generates an $8,200 tax liability as a result of having that on your tax return. That's what happens. Now, your portfolio might have a higher turnover ratio and it's trading more actively, generating more taxable income. You might have a buy and hold. This is concept, right? So if you get the concept, you're going to get the big picture. So now when I look at that same 68 mark, the tax, when you put these side by side, the tax has drained the account from $41,942,000 is what the screen says. $41,942,941. But when you pay the taxes from the account or from this portfolio, what you're seeing is that drained it to $24,670,000. So $18 million is basically gone. And now you're sitting on an unrealized long-term capital gain that's generating $2.2 million of taxes. So that's an $11 or $12 million capital gain. To get access to that capital, you would have to sell and pay the tax. Think about that for a while, right? And nobody likes paying taxes. We're assuming that the marginal tax bracket in this conversation is only 20%. Many people listening to this are in the 37% bracket. And we have a sunset coming in 2 years in 2025. So in 2026, that top bracket goes from 37 to 39.6. I'm only showing 20. I want you to understand that, like in a rising tax, this is going to get worse. So if I took this to 37% as the top marginal bracket, now a person making 250 is not in the top marginal bracket. That's why I'm not doing it. Okay. But that 37% bracket drains the taxes down even further. So we're going to bring this back down to 20%. So rising taxes, and we'll come back to that. So rising taxes could hurt this more. I have a 20% capital gain and a 5% for the state level. Now, you might live in a state that's the top bracket's 11%, like I do, right? You might live in California where it's, I think, 10.5. You might live in a tax-free state, so you're not generating this tax income. So the numbers are going to be different for each individual. But what you're looking at is, so if you're looking at the cost of what's happening on this scenario, the breakdown here is, there we go, that there's that $24 million. Now, what I want you to think about is the taxes on this. If we dump this all out to a spreadsheet, in the first year, the tax liability, as I said, was $8,200 on that portfolio. As I compounded up to 24 million, the portfolio tax has compounded as well, and it's $465,000. So it's actually 454, 464. Got to get glasses. It's more than the lifestyle cost. The lifestyle cost gone from $150,000 to $400,000. Interesting, right? So now, when you look at this, do you ever see a portfolio that goes up like this flatlining exponential curve, or is it a bumpy ride? Has this year's stock market been a bumpy ride? Was last year's? Was 2022? Was 2021? Was 2020? Was 2019? 2018? There's a lot of bumps in the ride. So what's interesting is most people believe that the average rates of return are what we get. We do not get average rates of return. We get volatility adjusted returns, meaning when the market is going up and down, you get a visual that looks like this, a bumpy road. Now, these numbers are wrong because they're looking at year-end numbers. So for example, here at 55, which would be 2008, the market was down 37%. In the following year, we know the market was down in March, down 25%, but ended up 26% in that calendar year. So you're going to get a different volatility adjusted return. But here at this 68 mark, 68, you're looking at this portfolio, and that portfolio has gone from 24.6 to 19.6. So the same rate of return has, because of volatility adjusted returns, because it's not a smooth ride, because money is not math, money is a commodity and it's subject to erosion principles, volatility adjusted return erodes capital. But what I want you to look at is that 19 million, $6 million of it is eroded through, 5 million of it's eroded through market volatility. There's less taxes, unrealized taxes at 2.2 versus 1.7. So you're thinking about this and saying, okay, so I'm riding up this piece. I'm getting this volatility adjusted returns. My pressure adjusted return has gone from an average of 12.42 down to 9.32. It's still 9.32. It's still a great freaking rate of return. Then there's management fees. Now, management fees on portfolios, internal, external expenses. So you have the internal expense ratios of a fund, the trading costs inside of a fund, whether it be an ETF or a mutual fund, or you have a separate account where you're actually, bearing that. Your fees might be higher than 1%. They might be 1.5. They might be 2.5. They might be 3.5. When you look under the hood and you really understand what's happening. But I'm just simply putting in here the concept of a 1% fee. And I'm looking at this and saying, what did the 1% fee do to the portfolio? That has dropped it from 19.6 to 14.9. Now, everybody pays fees. You can't invest money without having fees. I mean, it doesn't really matter what the investment is. There are fees, transaction fees on everything. But what I want you to look at is, in this portfolio, in the first year, the $400,000 generated about a $4,000 fee. Now, when I break down all these elements, the management fee in that year on the $14 million portfolio is $125,000. So while the account is compounding, so is the fee compounding. So is the tax compounding. So compound interest is a positive, compound fees is a negative, compound taxes are a negative against the portfolio. So this strategy, and then you basically say, okay, here I am, I'm 35, some financial advisor, financial planner, certified financial planner, which I am, so I can goof on us, okay, comes out and says, Mr. Jones, you need to buy life insurance because you have $400,000, you have a house, you have liabilities, you have 18 kids, and you're making $250,000, or you don't have 18 kids, you have no kids, but you need to protect your spouse in the event that one of you goes earlier. And we convince you that on $250,000, you should buy some life insurance. Okay. And what we said is, we're going to put the term insurance in. So this was the review from last time. And we said, we're going to go buy cheap term, because why would I want anything else but cheap term? Because I don't want it. I don't think it's something I should have. And I can buy 30-year term. I can buy 40-year term. I could buy 10-year level term. I can buy 20-year level term. But since we're going out here and we're looking at this over from 35 to 68, we're looking at this over, 33 plus years. I'm just going to put the 20-year term in, right? And the 20-year term for the $1 million of coverage that the advisor has convinced you to buy that you don't want, right, is $555. And you don't want to spend any more money on it because I'm not going to die. And that's when we look at this simulation. The yellow line on the simulation is the term insurance. And here at happens to be 56, which is my age. I can just imagine going home and saying to Sharon, we've done well, but it didn't meet my spreadsheet, right? I don't have as much money as we thought we were going to have, but I have, the market was down last year, was down 37%. We're back up, but we're at 3.4 million. We don't need the $1 million anymore because that premium is going to go through the roof in the next year. So I'm going to drop that. I love you so much, honey. I'm going to drop the $1 million gift that I have upon my death. And the kids will be fine because the kids are older and yada, yada, yada. It's all fine. So I dropped that term. And the impact is I get to 68 and that term insurance has cost $73,000 in wealth. There's an opportunity cost on the term premiums paid. It drained the portfolio, right? So it drained the portfolio. And I have $73,000 less, which is in today's dollars, that's a really nice car. Okay. But I also miss the $1 million death benefit. What if I dropped the term insurance and the $1 million came in at 57? It would have come in, but it didn't come in. What's my opportunity cost? It's massive. $1 million compounded at 12% or 9.24% in perpetuity for money that my wife didn't need, right? Has a tremendous amount of opportunity cost. And that's why families F themselves, right? They're not thinking about this. Now, you look at it and say, well, we can go to the 40-year term, right? And it's only $1,575. And you're like, yeah, it's level for 40 years. And I make that same impact. And now it gets me all the way out here to 60, a little bit beyond 70. So the life insurance is still here. And at that same 68 mark, I'm at $14,724,000. So that $1,500 a year has drained it from $14,977 to $14,724. That's a lot of money in opportunity costs when you start thinking about it, right? So I think what's really interesting is that is sort of the buy term, invest the difference conversation. Now, I wanted to pack this out so that the life insurance became something that we truly understood from that the proper need of the insurance. Somebody making $250,000, $1 million is only going to give the family $40,000 in income, right? If I take $1 million, death benefit comes into my wife yesterday, tax-free, and I say be conservative with it because you can't risk it because you got to generate income from it. And you take a diversified portfolio, you take a 4% withdrawal, and you hope that you're going to make more money. You're not going to have this volatility adjusted returns. You should take a 4%, but you're only 35 years old. The longevity of that money has to last all the way to you're 100. So the question is, what's the real withdrawal? It's lower than the 3% for the money to last over 40 years. So $1 million only gives 30,000. My question is, how many millions do you need to replicate the 250? And the insanity of this is, if I had a building that was producing $250,000 in free cash flow, how much would I insure that building for? A lot of money, right? Because what I would want to do is depends on the cap rate, depends on all the other shit that we hear, right? But it's like, if I have a 10% cap rate, means I'm making 10%, I need at least 2.5 million. If I have a 5, it needs 5 million. If I have a 4, it needs almost 6.2. So people that did planning in the 80s when the interest rates were 17% said, I only need $1 million to replicate $170,000. 10 years later, it was making 9. And if you died and you thought your family was fine, they weren't. So when we talk about life insurance, we typically talk in maximum, right? And there's maximum that a individual who earns money who's 35 can get somewhere between 20 to 25 times their annual income plus their net worth. A person who's retired with $19 million or $14 million of assets can actually acquire $14 million, one times the estate. If you think about it, if my human life value, my economic value is based upon what I produce, if I don't properly insure that and there is a loss, yes, I'm not here, right? But there's an economic loss to my family in perpetuity that I was underinsured. It's sort of like owning a house and having it underinsured. So think through this for 1 second. I got $1 million property that's generating $50,000 a year. I got $1 million of cash, and the building burns to the ground. And I got to spend $1 million to get it back. Today, I have $1 million of cash and $1 million worth of property. When it burns to the ground and I don't have insurance, I got to take the $1 million from the cash and put the $1 million back to build that building. So my net worth is gone. When the building is restored and back to its full glory, it's not worth $2 million. It's still only worth $1 million. So I just put my net worth in half by not having it insured. And on your balance sheet, on your wealth curve blueprint, the economic value of a person making $250, because a 35-year-old making $250, shit could go wrong, but a lot of shit can go right. What are you going to be making in the future? And it's all that economic value that we're not discussing that's going to happen out here, right? So I want to step back for a second and basically say the life insurance should be maximum at all times. If I was run over by a bus yesterday and my attorney called Sharon and said, John was run over by a bus. He makes a lot of money. He's accumulated money. He's got all this money. He's got life insurance. He's got all the stuff that he's talking about. Are you happy, or do you want to sue the person for running over your husband? What are we going to sue for? Well, he's making X. He's going to do that for another 20 years because he loves what he does. He wants to go to 75, 76 because he loves this. He's going to make more money in the future. There's pain and suffering. There's loss of a parent. There's loss of a spouse. There's business continuity. $10 million estate? $20 million suit? What are they going to sue for? Think about your own personal thing. If you make $250,000 and you died yesterday in an accident, your family's going to sue for 10 to 20 to 30 times what you're currently making, plus interest, plus all the lawsuit shit, plus all the care and all the stuff. But if you die naturally, they're going to take $1 million, your group insurance. Do you see the stupidity? I see it. Okay. Now, here's what we're going to do. I'm going to replicate this so we can come back and see it on both sides. But I want to change the game for a second. And I want to talk about the dirtiest word in the insurance business. And it's called whole life insurance. It's whole life insurance, right? You got universal life, you've got whole life insurance. And what I want to do for a second, I'm going to use a product structure that is called a whole life 100. Now, in whole life insurance, I want to talk about the economics of it before we jump into the mathematics of it, okay? Term insurance, we know, is a rental. So when I look at, for example, this 30-year term insurance, the premium for many of these is guaranteed. MassMutual's is guaranteed for the 30 years. Now, this has waiver of premium on this. $190 is $945 for a 30-year term. But when I get to age 66, that premium goes from $945 to $23,000. And then it goes to $26,000. And then it goes to $35,000. And by the time I'm 77 years old, $82,000. Who's going to be writing the check? For the first 30 years, the cumulative premium was $34,000. So I'm renting the insurance. And think about this. Your favorite restaurant's gone out of business multiple times. Why? Because the landlord said, oh, this restaurant's really successful. We're going to raise the rent on them. And they leave. And the business is gone, right? So the insurance company is saying, you're 65 years old. You're closer to death. We don't want to insure you for $945. But if you're uninsurable, you can't pass a physical and you didn't convert this to permanent insurance before, you have to pay $23,000. Now you're rolling a dice. You pay another $26,000. How many years in a row are we going to do that before we run out of money in other places and say it's not worth the $1 million? Okay. So when I talk about term insurance, that's why it's a rental and I don't have control over the product. Okay. Whole life insurance is a different strategy. Whole life insurance has a guaranteed premium, which means the premium is going to stay level for either all the way to age 100. If I do a 20 pay, that means it's level for 20 years, and then it's zero thereafter on a guaranteed basis. If I do a 10 pay, premiums are payable for 10 years, and then no premiums thereafter, and the policy is enforced to age 120. Okay, so there are nuances in this thing, but with that, the premium is guaranteed, cannot be raised, period. Imagine your car insurance can't be raised. All right? Imagine. Now, there is a guaranteed death benefit. And that guaranteed death benefit, if I buy $1 million policy, there's $1 million of guaranteed death benefit all the way through to age 120. Now, if I pay for it for 10 years or 15 or 20 or all the way to age 100, those guarantees are in the same place, meaning the death benefit's guaranteed out to 120. And on a whole life insurance contract, there is a guaranteed cash value, which means every single year, the insurance company says, based on the premiums paid, based on whether it's a 10 pay or a pay to 100, there's a certain level of guaranteed premium. And by the time you reach 100, that guaranteed cash value will be the $1 million. So you're guaranteed to get all your money back, plus there's a return on it. The structure of the policy is going to change it, okay? Now, you can buy a whole life insurance policy from a mutual insurance company, and there are some stock insurance companies that actually do them also. But a participating whole life insurance means as a mutual insurance company, the policy owners own a portion of the insurance company based upon the allocation of premium and death benefit that they pay to the company. And in that, there are dividends that the company is profitable, and those dividends have many options. They can be reinvested back in. They can buy what's called paid up additions, which increases your insurance over time. And you could use it to reduce your premium. You could take it in cash and enjoy it. There's so many things that you can do with it. But the idea is the dividends are not guaranteed. Now, when you look at all the top mutual insurance companies, Guardian and Mass and New York Life and a bunch of companies that are smaller than that, they've been paying dividends for 150 to 160 years in some cases, and they've never missed one. But they're not guaranteed. But once a dividend is paid and it's reinvested in the contract, it becomes part of the guarantee. Okay? So what's interesting is, so I've got these strong guarantees, and then I've got the variable of the dividend. Now, when interest rates are high, the portfolio of the insurance company will be high, and the dividend rate will be high. The element of this is that the dividend is made up of how well the portfolio is doing, 2, what the mortality experience is, right? So we're an insurance company. We insure 100,000 people. We expect 1,000 people to die this year. We don't know who, but 1,000 people are going to die. And only 800 people die. Are we profitable? Much more than we thought. But if 1,000 people die, that's what the actuary said was the expectation. We're still profitable. But when people live longer, they become more profitable. And then you have my favorite thing, which is the lapse ratio, LAPSE. If I do this 40-year term, or my 30-year term or my 20-year term, when I terminate my contract, the insurance company has a party because they don't have to pay out the $1 million death benefit and they get to keep all of your premiums. Now, if you terminate your whole life insurance policy, you get a bunch of cash back. They still have a party because they don't have to pay out the death benefit, right? They used your money for the period of time that they needed to use that money, and you cash it in at a spot when you think that you should have it, right? Now, in a quick format, you have a hybrid between these two, which is called universal life. And you have fixed current assumption universal life, you have fixed indexed universal life, you have guaranteed universal life, you have variable life, which is invested in the stock market. You have a lot of different versions in there. But internally, inside of those contracts, you have what looks like a yearly renewable term cost, kind of like that term, but it's going up every single year. So as you become older, the mortality charges become higher and higher inside that contract. And you see a lot of policies that were taken out in the early 90s when interest rates were 9 and 10%, where the interest rates are now down at 4%, and that mortality is getting super high, and it's destroying that policy, right? And the policies are lapsing before death. And we have a couple of those that we've inherited from our clients that the premiums are now the yearly renewable premiums. And because the cash didn't accumulate the way it was supposed to, right? There were no guarantees. And insurance companies, you've heard me talk about the 5 rules of the institution, right? So companies, we're safe, we're big, we're strong. The bank, the mutual fund company, we got a long track record. Our rates of return are great. But we want to feel comfortable giving us money. When we get the money as an institution, we want to hang on to it for as long as we possibly can. When you go to take income from it, we want to dribble out as much as we possibly can because you may run out of money. And we want the money systematically. I don't want the money once in a while. I want to get you into strategies that if I'm a bank and I'm doing a mortgage, rather than doing a 30-year mortgage and I get my money back over 30 years, let me give you an incentive and I'll give you a reduction in rate and I'll do a 10-year mortgage or a 15-year mortgage, right? Because the bank and the institutions want the money. I want a dollar cost average. Give us money every month. We need money under management, okay? The 5th option on that is we're going to change all the rules on you, right? We're going to change the variables inside the product. And that's what's going on inside a lot of these other products. You got to be really interesting here, okay? But what I want to do is I want you to climb into this thinking for a second. And I want you to understand, I'm about to jump into this whole life 100 concept. I'll come back, I'll show it on the screen also. But what we're doing is we're going to take some of the dividends that are being declared on the $400,000 portfolio, and we're going to reposition them into the life insurance contract. Okay? And when we do that, the life insurance contract, it has strong safety, right? Because you have big, high credit worthy insurance companies. So you're reducing risk, right? That's one of our goals. We're going to move money into the life insurance policy invested with the company, which reduces the risk because the policy a whole life policy cannot lose money, can only go up in value. It's structured on a guaranteed basis to go up. And then the dividends help it go up as well. It grows on a tax deferred basis. So meaning there's no tax during the accumulation. I can access my money at low cost on a tax-free basis. I can generate tax-free income in retirement from that policy. If I become disabled, it has what's called a waiver of premium, which pays the premiums for me. The insurance company pays the premiums because I'm disabled. You got to check every waiver premium definition. Some are 2 years on occupation, some are 5 years. You have to look at it, okay? But it is self-completing in the event that you become disabled, which is huge, okay? You start thinking about this as a college savings plan or alternatives. If I'm putting money in a 529 or my 401k and I become disabled, those things stop. If I'm putting it in a mutual fund, those things stop. So the value of this self-completing could be extremely valuable, okay? In many, many states, the cash values are 100% protected from creditors. So if I have $1 million of cash value and $1 million in my portfolio and I get sued, the $1 million in my portfolio is subject to my creditors. Life insurance, not. In many states, it has safe harbor protection, which means I can have a policy loan and repay the policy loan in the face of creditors, okay? And protect it. And there's a death benefit that's increasing all the way through. As I reinvest my dividends back into the contract and I use what's called paid up additions, so each dividend buys a little bit more insurance, which keeps it tax-free. By the time I get out to 65, 68, my death benefit will grow from $1 million to a much larger number, which I'm going to show you, okay? So the theory here is that when I do this and I reposition that capital, let me just make sure I took off the term. I didn't. There it is. Oh, I take off the term. I put in the whole life 100. And what I'm doing is when you look at this, it's a good year. There's about $42,000 in short-term capital gains and long-term capital gains being declared on the portfolio. And what I'm saying is we're just going to take $13,250 and we're going to reposition that into the whole life from the portfolio. And that's going to buy us the $1 million death benefit. Okay? And my taxes in this year, my portfolio tax is, $10,988, right? So it's increasing. That's what I wanted to do. We're doing it over here. I want to put it on that. So now we're out here and I'm repositioning that money into the life insurance, right? So by the time I'm 45, when you look at this, the cash value is up to $120,000, and I'm just repositioning the money into the plan. Now, what's interesting is when I look at the old scenarios, right? The secret to investing is to, buy low, sell high, right? If all my money's in and the market's down and I don't have a backdrop, buy term invest, the difference, I can't take advantage of the down market. Now, if I look at this is simulating the early 2000s, it's 2000, 2001, 2002, market's down 22%, and I got $205,000 of cash value. We could take a policy loan and invest that capital if we wanted to, if it was in your wheelhouse. Now, if you were buying term investing the difference, we're not increasing risk, but our overall rate of reduction, because the life insurance only goes up, our portfolio was buffered and the volatility was reduced, right? So if I have $14 million in the S&P 500 when I'm 68 years old, could that go down 50% in pretty much 3 to 4 months? Shit, yeah. It's already done it. 2000, that took 3 years to get down 50%. 2008 to 2009, we were down 52%. Could it fall 50%? And the answer to that question is yes. There's a belief that as I stay in the market for the long run, that my risk is mitigated. Now, it's the risk of your capital that you put in. But if I'm looking at the old scenario over here, and this is the term strategy, right? And I've got this money over here, and I'm looking at 68. And the market drops, this is down 18%. The portfolio is getting decimated, right? In that year. You're not going to be confident to retire, and you're not going to be confident to drop your insurance. Okay? But when I'm here, as I'm repositioning, now when you look at this illustration that I am using, when we use past performance to look at an investment, we're using the past performance of that investment. And past performance, you always hear the disclaimers, no guarantee of future performance. When you look at a life insurance policy, you're not looking at its past performance. You're looking at the current dividend scale. Now, who knows if the current dividend scale is going to be accurate or not? Nobody knows. Currently, the dividend scale at MassMutual is 6.1. I think Mass and New York Life and Guardian are very similar, all in their dividend scales. But as interest rates rise, that's going to go up. But we're not looking at the last 35 years. We're looking at the current future projection. Okay. So you have to make a decision as to what are you comparing your wealth to, right? So when we get out to 68, in this scenario, there's a cash value of $947,000 at 68. So we've been repositioning money into this all the way along the line. And our management fee, because I've been repositioning money into the life insurance, which, yes, it has commissions and fees and all those wonderful things, right? But they're there. But my management fees, if I'm just looking at 68, I've dropped from $122,000 to $100,000. So would you rather pay $122,000 in management fees, or would you rather pay $100,000? Would you rather pay the portfolio tax? It's $576,000 in the buy term invested difference, and it's $500,000 in this one. So, $100,000 reduction in fees. Now, cumulative over that time frame is really interesting. Now, we're repositioning money from a 9.2% net rate of return into about a 5.5% rate of return. Right? And when you look at where we are and you compare the two side by side, we have a combined 13.8 million versus 14.7. But I got there with a ton less risk, a ton less in taxes. Now, if taxes were not 20, they were actually 37, which one would perform better? Okay. I have this death benefit, current cash value, 947. So my balance sheet, current asset, 947,000. Deferred asset is the gross death benefit. I'm netting the death benefit. So it's a $900,000 net death benefit. So I actually have $1,850,000 of death benefit. I started with $1 million. I've got $1,850,000, but the current cash value is $947,000. So now I've got a volatility buffer beneath my portfolio, right? So I've got, in essence, to the same exact spot with less risk, less taxes, less fees, more savings, more benefits, and I'm going to pass more to my family in the future because the policy is going to keep on going, right? So now the policy is here for your entire life. And a whole life 100, when we look at the whole life 100, in this scenario, we decided to pay this all the way through. But on the policy, there are dividends. There are, you can get this premium to go to zero at 12 years, 13 years, 25 years, depending upon what you're doing. But if you look at this, here at 68, the death benefit's $1,800,000, 43, 69, and the cash value is $943,000. If I keep paying, it goes all the way up to $4.1 million, assuming the dividend stays the same at 6.1%. Now, if interest rates are rising, do you think dividends are going to increase? If people live longer, is the dividend going to increase? If people lapse their policies at the same rate that they lapse their policies, are they going to live longer? Yes. Okay. I'm not going to jump in and get into the minutia here, but I want you to understand, like, you start to think about if the market drops 50% and I'm taking money from my portfolio, what are the odds of running out of money? How much money am I going to take? Honey, we need to go on an austere budget, an austere budget. I need to we got to get rid of everything. We can't go on vacation. But if I have a volatility buffer, life insurance in retirement, we're going to be talking about that. I'm going to give you the quick thing here, and then we're going to finish up and we're going to go through. In the next one, we're going to make a comparison to a 10-year, to a 20-year pay, to a whole life 100. We'll start with that same concept and we'll just pick it up and keep running. But the idea is, this is not the proper amount of insurance in the entire time frame, right? The proper amount of insurance, the architected, the solution that's proper is going to be a blend of term and whole life, okay? And that whole life should be positioned that when I get out here to this $15 million, $14 million number, if I can orchestrate that I had $2.5 million, maybe $3 million of cash value as opposed to $1 million, so 3x the current policy, and that would give me $4, $5, $6 million of death benefit, actually more than that, gross. That's going to cover estate tax. That's going to cover all of the long-term care issues that I'm going to have potentially in my time frame. It's going to cover the volatility buffer. Is if I'm pulling out a lifestyle in this of $400,000, that's what I need to live my lifestyle on top of my fees, on top of my taxes. And my taxes, it's $1 million a year budget in this concept, right? And the market drops, I could increase the probability of running out of money if I'm pulling in a down market. I use the life insurance as a volatility buffer. I go to the life insurance to pull my money. If this year is a negative year, next year I go to the life insurance. And that takes the pressure off of the portfolio. Now, how do I use the death benefit in retirement? We're going to be talking about that, but I'm going to give you this really quick. How many people have a pension that are listening to this? And they don't really understand this, that when you retire, they're going to say, oh, you've worked for 35 years in the school system or for the company that still has pensions, and you can get a pension for $5,000 a month. Oh, you're married and you want to give your survivor a benefit. Do you want to give them 100% survivor or a 50% survivor or a 25% survivor? If it's a 50% survivor and your spouse is the same age of you, if he or she's younger, it's even worse. It might drop from $5,000 to $4,000. So it's costing you $1,000 a month to give your spouse a $4,000 monthly pension. Isn't $1,000 a month life insurance? And if your spouse died the next day, you're still stuck at the $4,000. If I had the life insurance as part of my plan, I could take the $5,000. I can pension maximize. That's the concept. It's called the pension maximization. I've got a $1.2 million tax liability at 20% in this portfolio. Maybe taxes are 45%. I don't want to pay the taxes. My money's stuck in jail. I could do a charitable remainder trust and let the life insurance be the inheritance tool. So I maximize my benefits. I could do an annuitization, which means I spend down my money. Instead of taking, I got $1 million, instead of taking $50,000 a year from that portfolio, I go to an insurance company and I say, I'm going to give you $1 million. In exchange, you're going to give my wife and I a $70,000 or $65,000 a year lifetime income that we can't outlive. But the caveat is when we die, the insurance company keeps that money. But if I have the life insurance, it restores it. One of the greatest assets, Tom Selleck is out there pitching it, which makes it funny, right? It's a reverse mortgage. So I spent all these years building my house, getting it perfect, and then I convinced myself that the house is too big and I moved to a smaller house because I got to downsize. Why do I got to downsize? Because I got to take chips off the table. If I have $1 million house or a $500,000 house and I have $500,000 worth of insurance that's paid for and permanent, why not do a reverse mortgage and get, $20,000 a year tax-free income? The list goes on of how we can use the death benefit in retirement. The death benefit can be used to dramatically improve, potentially, the inflation hedges, because the market doesn't necessarily give you inflation hedge. It doesn't. So this was a really interesting and fun conversation. I'm going to jump in and do more on this because I really want you to understand this. Now, what I hope in listening today, if you're still listening, you thought about the thinking, right? That 2 assets together, 3 assets together are more efficient and better than one by itself. Meaning a stock plan, S&P, is great, but when I marry it with a life insurance policy or a piece of real estate with a life insurance policy as part of an integrated overall plan, I reduce taxes, I reduce risk, I reduce fees, I generate more savings every year, I get more lifestyle, I get more enjoyment from my money in retirement, and I pass more to my family. That's what you're trying to do. That's what you want. That's what we want. So thank you. Till next time.